Well, good morning, Bruce.
Good morning.
Welcome back to the Money Advantage podcast. If you're joining us live today, we are back on the show together after, I have to say, a wonderful week. I know I wasn't there, but I saw the results of it. A wonderful time where Bruce and Cole in our team talked about what you really need to do and have in place to make sure you're getting the right infinite banking policy. So great job to Bruce and our team and Cole on that. And I'm happy to be back with you today. And we're going to be diving deeper into the study of this fantastic book, which we can almost refer to as the foundation, the doctrine of infinite banking, you could call it. It could even be called the Bible of infinite banking. It's really where infinite banking all began. This is from R. Nelson Nash. And when we are looking at this book, we've been walking through each of the chapters. We're now in part 6. And we are in the chapter, if you are following along in your book, this is on creating your own infinite banking system through dividend paying life insurance. We started part 1, or the first portion of that chapter we covered last time in part 5. It's been probably, I want to say, a month at least, Bruce, since we've been back in this book. So just a quick recap, we've kind of gone through the principles of what infinite banking is all about, how infinite banking got started when Nelson realized that he had this aha moment of recognizing he had access to capital in insurance policies that he'd already funded and created and been paying into for many years. And now he had access to this capital at much lower interest rates that really saved him from a financial upheaval in his own life. So that's where he realized the power of specially designed whole life insurance, and then created this concept called infinite banking and made it more publicly aware to other people like you and me who can take advantage of that. So that was really what we covered in part 1. We talked about how it's an exercise in imagination, how you need to think differently in order to use infinite banking. We talked about how it's like a grocery store, and really he talked about making sure that you're not being afraid to capitalize and start this policy where any business has huge upfront costs to begin with. That was kind of the point of that piece. He talked about the problem really being a financing problem where you have a lot of dollars that are flowing out of your control in interest to the banking system being a primary need over the need for insurance. Now, don't mishear what I'm saying. Nelson Nash did not say you don't have a need for insurance. He did not downplay he did not downplay the need for insurance, but he did say the main problem is that people have a financing problem or a place to store cash problem. And then we talked about creating a bank like the ones you already know about, really understanding the banking function and how you need to have a place to store capital, to make loans and be profitable. And that's the same thing that's happening inside your infinite banking policy. And now we're continuing on with huge concepts in this next section where we've talked about economic value added and a whole bunch of components of really understanding how your financial life works and how you can use the banking component in your own life. So Bruce, before we dive in today, let's just hear from you. What if maybe somebody is jumping in and this is the very first episode they've ever heard of the infinite banking concept, and maybe the first time they've ever heard from us? Let's just let them know why this is so important for us to talk about.
Yeah, so Nelson realized through his observations that you already mentioned this, a person's need for financing is greater than their need for insurance. And he didn't, like you said, he didn't mean that you didn't need insurance. He said it was greater. And a couple of examples that he gave is you hear a lot of people say, and I still hear it today, people say, oh, I don't want to be insurance poor. I don't want to be paying so much into a insurance policy that I'm worth more dead than alive. And I tell people all the time, well, that's absolutely impossible because the actuaries will not allow that to happen. And he says, he gives examples like, a person says, I have to pay all this premium. And I would say, no, you don't have to pay all this premium. You get to pay all this premium. It's a good thing. And, they might pay $10,000 a year a premium. And they're thinking, oh man, I'm insurance poor. I can't pay this. And yet If they look at how much they're paying interest on their home, it's well over $10,000 a year. And yet the premium is actually an ever increasing pool of money. And the interest that you're paying on your home is actually just money that is leaving your net worth. And so Nelson said, it's kind of weird that people are willing to have money up to 35% of their income go out for financing, and yet they do not see that as a problem. But having 35% of their income going to premium, which is an ever increasing supply of money, they see that as a problem. Mm-hmm. Now that comes down from many, I think, money mindsets. The first money mindset that I in my career that I think people have is that when you do an insurance policy, you're facing your own mortality. And people have a hard time facing their own mortality. I mentioned this on the phone or the podcast before. We all know we're going to die, but we don't really believe it. And that as a biology instructor, that is what I believe an evolutionary thing that has happened to us so that we don't fixate so much on dying that we don't live a productive life. So that is something that I think money mindset wise, people have a hard time getting over. So if they realize that their need for financing is greater than their need for death benefit, and that's a secondary thing, then you should be more excited about getting an ever increasing pool of money so you can take the financing into your own hands and stop having that 35% volume of money flowing out of your control. And then the final thing, a person's coming in, yeah, okay, that sounds great and everything, but why don't I just pay cash for this? And we've already established that you finance everything, whether you pay for cash or you actually go to a financing company, because you're either giving up interest or you're paying interest. Now, in the last 12 years, we're doing this in the spring of 2023. The last 12 years, interest financing costs have been very, very low on a percentage basis. So a lot of people have dismissed that. But now as the interest rates are coming back to what I would call more normal rates, lack of manipulation, then there is a significant cost to capital as you're borrowing. Right now, home loans are well over 6%. So there's a significant cost to that borrowing. So Nelson was trying to help people understand that, one, save first, having an increasing pool of capital is always a good thing. And then two, have you understand that becoming your own bank is bringing that banking function into your own life is not only going to help you with your recapturing financing costs, but it's also going to help you bring control into your life.
Bruce, you said you said a lot of really awesome things. I want to come back to the point that you mentioned about we're all going to die. We don't necessarily believe it. I think there's that tension, this balancing piece. I mean, if we all walked around like, we're going to live forever, we might take more risks and we might not be cautious and we might live in a way that isn't congruent with our character. But if we also thought, I'm going to die tomorrow, either that's going to be fear-inducing and we're all going to walk around with a really heavy head and slumped over shoulders and being like, well, what's the point of anything in life? Or we're going to live it to the fullest. I mean, there's all kinds of ways that you can address that, right? If you hold the best perspective of both, that you want this long life and you also don't know how long it's going to last. If you really are in that perspective, you can think about, if I did live for the next, just say 300 years, next really long time, past any human lifespan, what would be possible for me to create in the world? What impacts could I then have on others? And if I didn't know how long I had, I really want to make every moment count. And I think that's really the crux of having a good perspective of our mortality, and knowing that we're not going to last forever, but we have the capability of creating lasting impacts forever. And that's one of the things I love about infinite banking and about life insurance in general, is that it's not really just about me. It's really about what I can do during my lifetime in order to create a foundation so that people after me can also have this starting point that's beyond where I started. And if we all thought that way, we would probably be able to embrace our mortality in a more healthy fashion. So I'm going to jump into the topic here today. And what I want to ask, if you are listening live or if you're listening after the fact and you're at this point in the podcast, I would like to hear a couple of things. If you could drop in a comment, have you seen the 5 earlier portions of our series on becoming your own banker? So that's question 1. Have you seen the first 5 pieces, sections, chapters, episodes, there we go, of the Becoming Your Own Banker series on the Money Advantage podcast? That's question 1, yes or no. And then I would also love to know, have you read Nelson Nash's book, Becoming Your Own Banker? So those are clearly both yes, no questions. If you just put yes or no, we're not going to know which question you're answering, but yes, I've read Nelson Nash's book. No, I haven't read Nelson Nash's book. I would love to know where you are at in this journey of understanding and discovering whole life insurance for yourself. So thank you, Fritz, for jumping in on YouTube. We'll be back with you in just a moment. Thank you for commenting and for listening live, and for all the rest of you who are as well. So let's jump into the reason or the purpose of this conversation today. We're talking about dividends. What is the power of dividends in a life insurance policy? And probably if you're in our tribe and you've been listening for a while, you say dividends. Oh, I know exactly what you're talking about. But just for a little bit of groundwork, in case you are not familiar with what a dividend is in a whole life insurance policy, I'm just going to give the super fundamental bare bones description. Whole life insurance is insurance that you have for your whole life. And I'm again oversimplifying a little bit. Yes, it lasts to age 121. If you get a policy now, that means it endows at that point. It pays out to you if you haven't died already. So it is going to last at least till the end of your life. So what that means is that you not only have a death benefit inside life and a whole life policy, you also have cash value. It's like equity in your home. That cash value is growing with 2 things: guaranteed interest and 2 non-guaranteed dividends. Now, you might say, why would I want something that's not guaranteed? And why are you making a deal about something that's not guaranteed? I mean, that's a fair question, right? Well, dividends for companies that have been around for a long time, that we work with, that have stable financials, are in a position where they've paid dividends every single year, even through the worst of economic times. So they can't say, I'm guaranteeing that you'll get a dividend. However, if we look historically at their performance, the track record says they're going to pay dividends. So it's not a guarantee, but it's highly likely that they'll pay dividends. Now, when you have a policy growing with interest and dividends, you have multiple things that the dividend can do. A, it's adding to the growth of your cash value. B, if you structure the policies in a certain way, you can have those dividends purchase more paid up insurance, which then increases your death benefit, increases your growth, has a compounding effect, and then you're growing dividends on your dividends, where you're growing also interest on your interest. This is very powerful because it's a way to not only have life insurance, you're also getting this cash storage where you're storing capital, and it's safe. It's not going to drop in value. It's liquid because you can access it. We've covered a lot of these components. I'm just glossing over them now. It's liquid because you can access it through policy loans, as much up to the cash value you have inside your policy. And it's growing. It's growing at a better rate comparatively to other similar components or similar tools of places to store cash. So, Bruce, I don't know if we need any more foundation. I don't want to belabor that point. I'm sure most of our audience is already extremely familiar with that. But let's talk about where Nelson Nash jumps into this portion of the chapter. If you're following along, we're on page 22. I think this is the 5th edition of Nelson Nash's book. And so a few paragraphs down, and we're jumping in here where he's talking about over-engineering a policy. Bruce, I'm just going to give the lead in that he talks about with the gaslight on your tank. And then do you want to pick up how policies are over-engineered from that point.
Go ahead.
Okay, so he talks about life insurance policies being over-engineered. And you might say, what does that mean and why? And he relates it to the gas light on your tank, your dashboard in the car that tells you your tank is empty. Now, when we first are brand new drivers and we're 16 years old and we're, not paying attention to how much gas is in the tank and we're just trying to figure out driving, all of a sudden that light comes on and we say, oh my goodness, I need to get to a gas station in the next 10 seconds or I'm going to be dead on the side of the road. That's not necessarily true because the car is over-engineered to have more space in the tank, more gas left when that light comes on. It's a warning light. It's telling you, hey, if you haven't been paying attention to me all this time, the gas gauge has been dropping and you probably haven't noticed, but now that this light is on, you really, really do need to pay attention. However, it's not urgent. You do not have to screech to a halt, turn around and get back to the gas station you just passed 3 minutes ago on the freeway. Instead, really, most cars, when you do research, have about 30 to 50 more miles left to go in the tank. Some cars even up to 100 miles when that light comes on. They over-engineered the car to tell you the tank is empty. It's not fully empty because the car manufacturer wants you to be in a safe position and wants you to make sure that you're going to take care of that problem, but they're not going to tell you right at the last minute. So Bruce, how does that relate to how life insurance policies are over-engineered?
Well, actuaries are interesting people. They're highly intelligent people and they're highly conservative people. And so when a dividend is declared for after a whole lot of things that the actuary has actually done. And what the actuary has done is looked at the mortality of tens of thousands of people in age groups, gender, and have certain habits. And they then come up with a rate at each age, and they determine what that rate will be. And then they, as Nelson says, they put a little fudge factor in there. They put a little extra just in case kind of situation in there. And that just in case is what Nelson talked to us about over engineering. Or as you said, the light on your car coming on and says you're at empty, but you're really not. They're just over engineering it. And so that over engineering is additional profit to the company. And that additional profit is a just in case something would happen. What would the just in case be? Well, let's go back to how dividends are actually totally figured out. So you have to have a rate first, and that's the expense of just the cost of the insurance. But that's the highest expense. But that is not, that's the cost of the insurance in case there's a death benefit. The death benefit is the highest expense to the company, but that's not the only expense. You have home office expenses. You have real estate to house home office. You have commissions paid to people to present the whole life insurance contract. And so all those expenses are on the book, just like any other business, just like a service station that you were talking about, gas station, just like a mobile phone business, just like any mom and pop restaurant. Those are expenses. And then they have income coming in. What is the income? Well, the income is from portfolio, what they invest things in. So they're collecting all the premium and they get a portfolio return. What other income do they have besides portfolio income? They actually have income from the interest that they charge on the loans. So that is also calculated in that. At the end of the year, the actuaries have designed this. The CFO of the company, along with the board of directors, look at all of this, and they've done a great job of determining profit over hundreds of years. And so all the companies we, as you mentioned, have always declared a dividend over hundreds of years. So they come about and they say, we have a profit of X, which is, I think Nelson uses $1.25 or $1.20, something like that. And he says, if they're smart, and actuaries and CFOs are smart, they're going to take a little bit of that profit and put it into reserves. So just in case they mess up in the future. or just in case there's a catastrophic event that happens in the future. Then they're going to take the remaining profit and they're going to distribute it to the policyholders because they're owners of the company. There's no stockholders that they're beholden to. They're just the policyholders get the dividend. And those dividends can be, as you already mentioned, they can be just sent to you. They can be held at the company in what's called they can accumulate at the company in an interest-bearing account, just like a bank, or they can buy paid up additions. We believe that the most efficient way to do it is to buy more paid up additions, because then you're going to get actually, once again, that compounding effect, because you're going to be making interest and dividends on the paid up additions as you keep this giant flywheel going further and further. Another real important point, Rachel, is that once a dividend is declared, it's guaranteed. So most people, when they are afraid about, well, what about these dividends? They're thinking about stock dividends, and a stock dividend's declared. A lot of times people do the same thing. They say, we're just going to reinvest the dividend into buying more stock. Well, as soon as you do that, then that stock is no longer guaranteed to stay at that price. So your dividend's no longer guaranteed. But in life insurance policies, the contract says once it's declared, it is guaranteed. So that is a really important point for people.
Let me add to that. So this is a point Nelson talks about in a little bit, where on the non-guaranteed side of the illustration, you're going to see non-guaranteed dividends listed out every single year. You're going to see them listed at today's dividend rate. We know that an illustration is not going to perform exactly, or your contract, once you put it in place, is not going to perform exactly like the illustration, because the illustration is using today's figures to map out what the dividend is going to be in the future, where we know that dividends rise and fall based on primarily the bond market. And when we see bond rates and we see interest rates rising, then what that does is typically dividend rates rise within the company. It's not a guarantee again, and usually there's some lag time, but dividends can change from what the initial illustration mentions. However, what Bruce is talking about is once that dividend is declared, they're declared each year, and then it's applied to your policy, it now becomes, that portion becomes part of your guaranteed cash value over on the left-hand side of your illustration for your actual performance, your actual experience in the policy, or your in-force illustration, not your projected illustration that you get before you purchase. So what Bruce is saying is that the dividend is paid at whatever that dividend rate is for that year, and it's figured based on the percentage that you're going to get for your policy, and then it becomes applied over on the left-hand side. It moves that paid out amount moves from the right-hand non-guaranteed side over to the left-hand guaranteed side of the contract, rising what your guaranteed amount is above what the guarantee says on your illustration, and then that's where it sets a new floor, and your cash value is not allowed. It's not able to drop beneath that in the future. So it absolutely is applied to the guarantees, becomes guaranteed, becomes solid ground beneath your feet. And the next year's dividend is then again not guaranteed, but highly anticipated.
Yes, and some people are worried about the fact that currently under current tax law, dividends are not taxable. And they're considered a return of premium. And everybody that is against whole life are saying all they're doing is giving your money back. And
Bruce, can I say something before we go there? Just because I think it might help pave the way for somebody who is maybe a little less familiar. So this over-engineering piece is Nelson mentions, I'm going to read about 2 sentences that he has kind of plugged in between these two concepts where we're talking about what a dividend is and how this policy is over-engineered, and then where Bruce is going with it being a return of premium. So Nelson says, furthermore, the policy is engineered to become more efficient every year, no matter what happens. That is, if the owner does what is called for in paying premium, loan repayments plus interest thereon that are at least equal to or better than the general investment portfolio of the company. So he's saying, if you fulfill your end of the contract, then you're going to see the company's going to be more profitable than they're projecting on the illustration with your dividends. He says that's because the cash value is guaranteed to ultimately reach the face amount of the policy by age 100 of the insured. We didn't mention that before. So if you're familiar with life insurance, you're like, yes, you're preaching to the choir. If you're not as familiar, the death benefit, especially if you structure it where your dividends then buy more paid up insurance, your death benefit's going to rise. And also your cash value is going to rise. Your cash value is going to rise no matter what. They're going to meet each other at the end point of the contract. So that means your cash value is getting closer and closer to the death benefit the further on in the policy, the longer you have it. He says there is an ever decreasing net amount of risk for the company. And then he talks about an airplane and this whole idea of increasing in efficiency with time. Like an airplane, as they're burning fuel, the plane becomes lighter, which means it can fly more efficiently or faster the longer it's in force. So that's where the over-engineering comes in, where you could argue and say, well, the reason or the way they're over-engineering is if they're charging this amount of premium, then they didn't really need quite that much premium in order to cover all their costs. And that's why they're turning a dividend back to me. And that's why it's called return of premium, which is where you're going with the tax piece. Go ahead, Bruce.
Yes. And remember, dividend, we hear dividends, and a lot of people hear dividends now for stocks, but dividends actually came out of the insurance industry, and it predates the actual tax code of 1913. And
Nice.
So when that happened, then they decided that this was just a return of premium and it would not be taxable. Now, I've argued this before because people say, see, they just overcharged you. That overcharging is a just in case, but they're returning that to you. It's similar. I tell people and I always use Coca-Cola because they pay a nice dividend. You could say the same thing about Coca-Cola is having all the profit is additional dividends now that they can give. Well, that means they charge you more for a can of Coke than they needed to charge you for, and then they wouldn't have any dividends. So the same thing could happen in the whole life insurance contract. Yes, they could lower that, but if they lower it, then they bring in risk, and actuaries don't want to face that risk. And the other thing, it would lose the tax-free amount. And as it grows, Rachel, you're it's absolutely true that the cash value is always chasing the death benefit. So the more premium you put in, the more dividends that are declared, and you're growing your death benefit. Growing your death benefit actually means you're growing your cash value because they have to meet. Because the cash value is the net present value of a future death benefit. So they have to meet at age 121. And in Nelson's book, it's age 100 because the products that he was using at that time and the mortality tables at that time in 2000 were actually less. So they actually met at 100 at that time. But they actually go to age 121. So this is then people say, well, what if Congress takes this away as far as being tax-free? Well, first of all, it's a contract. It is literally a contract. An illustration isn't a contract, but life insurance contracts are contracts. And Nelson used to say this all the time. Could Congress try to take it away? Yes, because he was not a fan of Congress. He was not a fan of taxes. But in order to do that, they will almost have to grandfather everybody that has a contract now and not change it, because tax codes are not contracts. But contractual law in our society is the backbone of our society. Nelson used to say that all the time. And there's precedents for this. When they changed how the MEC limits were in '86. They actually did not change the MEC limits for previously declared contracts. So there is precedent for this. The other thing that take in consideration for dividends being still remaining tax-free is many of Congress actually own permanent life insurance in the form of whole life. I've said this on the podcast before. All you have to do is it's for public record. You can go look at this. President Biden actually disclosed all of his financials, and he owns 4 whole life insurance contracts. So Congress themselves actually hold this. And so why would they? I mean, they could, I guess, but more than likely, they're not going to pass a law that's going to be to the detriment of themselves. That's what they do on a daily basis.
In the foot. Yeah.
Right. That's what they do on a daily basis.
Bruce, really quick, before you move on, that reminds me of the question that I think a lot of people ask when they finally learn about infinite banking. I think everyone has this epiphany, like, why in the world are not more people doing this? Mm-hmm. Because it makes so much sense. I can store my capital, build a death benefit at the same time, have cash value I can access and use. I can use this during my lifetime. I get uninterrupted compound interest. I can access this capital, pay back with non-structured loans, leave a legacy to my children. Why wouldn't more people do this? Well, there's a saying, and I don't remember who came up with this. You probably know. They said, basically, those who understand do. Do you know where that quote originated from?
No, I don't. But, that's very similar to what Nelson used to always say. If you understand the problem, you'll understand what to do.
Right.
It's very, very similar to that.
Yes. I think it's just so fascinating that, you're saying a lot of wealthy people, a lot of people who understand how the financial system works are using cash value life insurance. Not all of them. We clearly can't say every single person who's wealthy has life insurance. You can't make that generalization. However, many people who understand how these things work are wanting to use the guarantees and the power of life insurance, which again, largely comes to the dividends that are paid inside of the life insurance policy, which is why we're having this particular conversation today.
And it is nice to know that, and you mentioned this, the longer you have the contract, the more efficient it becomes. And the reason it becomes more efficient is just like he says in the book, anybody that is going to start a company is actually going to be inefficient because it takes capital to start the company at the very beginning. Now, he says it takes about 7 years to turn a profit. I think with our buddy Mike Michalowicz and so on and so forth, we would say it should take a lot sooner than that. But, even 3 years or 5 years to turn a profit. It's funny how people will put capital into a business and not expect that to come back to them for 3 to 5, 7 years. But people put money into a contract and want to have all that money available in the form of a profit right away. And I think if they actually sat down and thought about it, they would think that was pretty silly. The other thing that we could compare to all the time is the securities industry. And I think if people don't know on the podcast, I am a financial advisor, so I have experience in the securities. And I hear this all the time with some of my, not colleagues, because my colleagues embrace this, but other people in the industry, they say, yeah, but when you have a stock, it's immediately liquid. So if you want to get out of it, you can get out of it. And I say, well, then you're not really doing your fiduciary responsibility, because when you do that, it's supposed to be a long-term investment. And the second thing is what I've noticed over time period. Yes, it's liquid, but when do you liquidate it? So example, let's say you put $100 into a stock and it takes off and it goes to 120. You often hear a person say, oh, don't sell it now because it's going to keep going. Or you put money into a stock and it goes down to $100 and it goes down to 80. And the person says, well, don't sell it now because you're going to make your money back. So if you don't sell it when it's going up and you don't sell it when it's going down, technically it's liquid, but is it really liquid? So that is
liquidate. That's the question. Do you want to
liquidate? Do you want to liquidate?
Mm-hmm.
And so all of those things, when you rethink your thinking, and that is part of Nelson's tenets, of IBC is you have to rethink your thinking about how you do your cash management system with your money. And the final thing, and Rachel will move on, is, one of the things that is also bothersome for some people is, and we just got another email this morning that Lucas shared, is, about the safety of this. And I tell people all the time that one of the reasons they over-engineer it is to build even more safety net into the system. So that should be also very comforting to people, that insurance companies are taking care of your money, because they have to, by the regulators, because they have long-term promises by contract to make, where stocks, bonds, mutual funds, there's no contract that says we are going to pay this out at this time. So that's just something to consider.
I think the fundamental question behind that, is it really safe, comes back to this idea that most people think of their money, their growing money, not their spending money, but the money that they're doing something with for the future. The automatic thought is, let's invest that. What's the rate of return? What's the risk of this? Well, whenever you associate a higher rate of return, there's usually a higher risk rate associated with that, which then means not just the risk of it not having a good rate of return, it's the risk of loss and that potential loss of capital. And so often when we think about growing money, we're not also at the same time thinking about safety of money. And I like to just isolate the two purposes of money completely and say, on one side, you have a need to store cash that you can depend on. I mean, that's really what it comes down to. The reason we use a savings account and not stick all of our money in the stock market is because we need to know, well, hey, if I have an emergency tomorrow, I need to get to $1,000 or $20,000 or whatever it is for you in your financial economy. I need to get to that money. I need to know it's there. Not, do I have to jump through these hoops? Do I have to pay taxes on that? Is it going to take me 3 weeks to get it? Is it a possibility it won't arrive? I need to know that I've got that capital. So it's something I can depend on. That's a place to store cash. That's where I'm going to pay my employees out of. That's where I'm going to be in a position of having my regular accounts payable come out of. I'm going to be wanting to have capital I can touch and access and use that I can depend on. The other side is money that you're growing, hopefully, for the future. And when you think about life insurance, this comes down to what Nelson says here, that the obvious need for financing, he's talking about paying for things in your life. The obvious need for financing is much greater than the need for life insurance and protection. I mentioned this earlier, but here he says this in the book. If he'd solve the need for finance through dividend paying life insurance, he would automatically have much more life insurance and recover all the interest he's now paying to someone else. And then he says, but this almost never occurs because the mental block implanted by financial genius is that life insurance is a poor place to store money, which brings me back to the point that people think about life insurance as an investment, and it's not. A safe place to store cash is different from an investment with risk. And when we say, well, how safe is it really? We're usually leaning on that investment side. Well, how safe is this investment really? Is it going to lose value? Could I lose it all tomorrow? Is it likely to lose all of its value tomorrow? Or is it highly unlikely to lose all of its value tomorrow? But we're still talking about a gradient or a spectrum or a scale of risk level. When we're talking about life insurance, there are guarantees. There are literally guarantees. You have a guaranteed death benefit, a guaranteed amount the life insurance company will pay out to your heirs should you pass away. You have a guaranteed cash value amount, which is literally a floor, the minimum amount of equity that you are able to access in this policy at any given time. It is a place to store cash for that purpose because you can depend on that guaranteed cash value. There's also guaranteed premium, meaning if you're committing to pay $50,000 a year in policy premiums, they will not be able to come back to you and say, well, actually, to fulfill the death benefit we said we were going to give you and fulfill the cash value we said we're going to give you, you actually need to pay $100,000 in premium every year going forward because we messed up. They can't do that because your premium is guaranteed, meaning it cannot be raised in order to fulfill the other guarantees inside the policy. So all of that means we need to separate and isolate those issues. Life insurance is not a good investment because it's not an investment at all. It is not a place where we should think about risk, levels of risk, amount of risk. It's not risk. That's why we believe and we love pure whole life insurance, not hybrid forms of life insurance. That's why I don't have an IUL personally. And that's why I'm not a fan of VULs and universal life, because those try to merge and mesh together this weird mix of, well, it's safe, but there's also this potential for higher growth, which actually means you're introducing risk to the policyholder. You're taking on more of the burden of risk. It gets really complicated and messy. But when we talk about pure whole life insurance, we're really talking about guarantees. Yes, there are guarantees. Yes, you can depend on it. Is it risky? Could you lose money? No, it's guaranteed. So that is why we need to separate what investments are versus safety, and think about the need for financing is the need for paying things in our life, which if we solve that need and we recognize how valuable of a place life insurance is to fulfill that need, everyone would automatically have as much insurance as they can get, really is what it would come down to.
Yeah. And Chad Hewitt says he always asks myself that question, why isn't everyone doing this? I had another colleague of mine answer to that question. It's kind of flippant. He says, that's because they haven't talked to me yet. Everybody hasn't talked to me yet. And I think we're starting to see that, as Nelson used to talk about the efficiency of a policy being a flywheel. And a lot of people don't understand what a flywheel is. But it's also on a car, and it's also a grinding stone. But it's hard to get this big heavy object to turn. But once you get it turning, it's hard to actually get it to stop. And so if more and more people understood that, if they could have some patience at the beginning, that this is just a place that you should put your money, just like you would put it into a bank. And you're going to get a lot of the attributes of a bank, not all of them. That's why insurance companies want to make sure everybody understands that this is not actually a bank. Mm-hmm. Okay, but you're getting the attributes, especially the borrowing attributes of a bank, but you're using your money as collateral. And when you think about it, a real bank, you're also using your money as a collateral, or excuse me, the bank's using your money as collateral. So there's not much difference between the two. More and more people are jumping onto this strategy. One, Nelson has done a really good job of putting his institute together, and it's being carried on by his son-in-law now, David Stearns. And through the power of social media, more and more people are gravitating to this. However, with a word of caution, I would make sure that you're actually talking to somebody that is following the 5 tenets of Nelson Nash Institute. And the best way to do that is to look for a practitioner. And you can go to infinitebanking.org and look for a practitioner in your area, or obviously you can call us, because I am a practitioner with the Nelson Nash Institute. So I do believe more and more people are going to gravitate to this strategy.
Bruce, 2 things on that point before we move on. You mentioned the 5 tenets. Secondly, you mentioned the caution to make sure you're getting what's true infinite banking, if that's what you're wanting to do. Now, if you're not wanting to do infinite banking, then don't do infinite banking. But if you want infinite banking, you want the guarantees I just mentioned, you want that place to store cash, you want that growing cash value, you want dividends to amplify the growth of your policy, you want to structure it in a way that you have a rising death benefit, you want to leave a legacy for future generations, then do infinite banking, because that's what infinite banking does really, really well. So I wanted to put a plug in for the episode you did last week. Again, I mentioned this at the beginning, but Bruce did an episode that covered a document that we've done that's part of our Privatized Banking Secrets course last week. And it's basically a self-assessment for you to go through and find out, before you buy a life insurance policy, what exactly you need to answer, and it will help you discover if you're buying the right policy or not. So it goes through 3 components, 3 sections, and it answers, am I getting the right policy design or the right policy? Am I working with the right insurance company? That's the insurer. And then also, am I working with the right producer or the right agent, the right financial advisor that is helping me. So right policy, right company, right advisor. Or are all three of those pieces in alignment with me and what I need? It's a self-assessment for you to be able to understand that. So go back to last week's episode. For some reason, my chat is not working. Oh, maybe it is now. And I'll go ahead and pop the link for last week's episode into the chat, and hopefully it will show up for everyone who's watching live. The other thing, Bruce, can you go through those 5 tenets really quick, just for somebody who might not know what you meant? Nelson Nash's 5 tenets.
Yeah. So first one is to think long range. That means don't just think, well, what is my money going to do for me right now? To actually don't be afraid to capitalize. So if this is a great place for your money to lay, then you need to put as much money in there as possible.
Mm-hmm.
Don't steal the peas, which is a funny story in the book about basically, hey, if you're going to borrow from the insurance company, which is using your money to collateralize, you need to pay it back. You need to be an honest banker, just like you'd have to pay an actual bank back. You need to not do business with banks. And this is an Austrian economist way of thinking. Nelson was an Austrian economist. And I think everybody right now is feeling that the central banks or who actually control the money supply have actually manipulated our economy, and we are actually having massive inflation because of it. And Nelson believed if enough people would actually stop doing business with the banks, that the banks would actually have to go back to more customer service, and the Federal Reserve would actually have to have better monetary policy. And then the final one is to rethink your thinking, and not just about this, but about everything. You need to think about everything in your life. The problem is people don't slow down and just think right now. And then they don't think about the way they think. And so it's
That's
not
a lot of work
just
to do that, isn't it, Bruce?
right. And so it's not just about rethinking the way your money works, but also the way our economy works, the way the human behavior is. And he talks about Parkinson's laws, he talks about the golden rule, human behavior. You have to think, why are you thinking like this? What influences are upon you?
Mm-hmm.
So those are the 5 things that Nelson talked about. And if you just apply those things to your daily life, even if you don't do infinite banking, I think it's really, really helpful for you to progress as a human being.
Absolutely. There's so much I could say on that right now, and I'm not, for the sake of time, I'm just going to jump to the end of the chapter. I'm going to read a section from Nelson Nash's book here. So he's gone through why and how you can create your own banking system through dividend paying life insurance. And we've walked through most of that today. At the end, then, he starts talking about basically how can you understand the infinite qualities of infinite banking. That's kind of the point of this section I'm going to read. So he says, then why not expand your own potential by buying all the life insurance on yourself and that the companies will issue? And then on all the persons which you have insurable interest. You don't have insurable interest on everybody. You don't have insurable interest on the person who drove past your house this morning, or your neighbor, or your friend, or your friend's grandmother. You don't have insurable interest. Insurable interest means that if something happened to that person, you would be financially at a detriment.
Or
right?
emotionally.
Yeah. Okay. I was like, am I saying that the right direction? So this would usually mean your children, could mean your parents, your grandparents, if they're living, and you are financially responsible for taking care of them, or could be, or would be, your spouse, a business partner. Those are the type of people you have insurable interest in. And then Nelson goes on to say, at present, does not all of your income go through the books of some banking institution? Don't the banks lend out the deposits of customers? All they do is capitalize the bank, capital stock, and make it a safe place for customers to deposit their money and then lend out the money left on deposit. If they don't lend money, they'll go out of business. Then he says, it'll take the average person at least 20 to 25 years to build a banking system through life insurance to accommodate all the needs for finance. But once such a system, I'm skipping over a bit, once such a system is established, it can be passed on to future generations as long as they can be taught how the system works. The point I want to make through reading that section is that you can't be thinking short term. You really need to be thinking long term, just as Bruce just mentioned as one of the tenets of Nelson Nash's and how you do infinite banking. You need to be thinking long term. You can't be afraid to capitalize. We have a policy right now that's still in the capitalization phase, meaning we haven't on that policy recovered the amount of premium we've paid in to the amount of cash value we have. So our cash value, is lower than the amount we've paid in at this point. But we know, based on the way that these work, because we understand the mechanism and the mechanics of whole life insurance, that this is a long-term play. This is something we're in the current capitalization phase, and we're about to come over the hurdle of that. So we're not 25 years in. I hate to say it. I wished I had started this when I was 2 years old. That would be amazing. I didn't know at the time. My husband and I didn't come to this conclusion about life insurance. I think we started our first policy, and a pretty small one, about 9 or 10 years ago. I think 9 right now. So I wish I'd known this sooner. I wish that I'd come to the light and understood this. But what I do know now is that as I'm building these policies, it's going to take time. And as I'm building this capital for myself to use, not only in my own lifetime, I now have this powerful tool to pass on to future generations. And by pass on, I mean the death benefit payout is always going to be more than I paid in, which means my kids are going to have more than I ever put in because of the growth inside the policy. And then if they're taught how to use it, they can use that capital that they now have because they've received this death benefit at my passing and my husband's, and they're able to say, now, how do we turn this into more of a foundation for the next generation? And so that's what Nelson Nash is talking about in terms of developing a system of policies. Bruce, anything you want to add on and wrap up with here today?
Yeah, the only thing I would say to wrap up on this is Nelson even talks about in a book. He was a life insurance agent. He wasn't a life insurance agent at the very beginning, and he actually took out his first policy when he was a teenager himself. And so then he worked as forestry for a while before he actually became a life insurance agent. And so when he set up his first policies, they weren't set up the way that he would like them to be set up now. And so he made some mistakes. And then the other thing that I tell people all the time is Nelson lived what he preached. And the way he did that is he did not get the banks out of his life until he was age 67. Okay, so he started taking out policies in as teenager, and it wasn't until age 67 where he got the banks out of his life. So this is a lifetime process. This is a way of life. Okay, it's not something that you try. I've been telling that to potential clients all the time. And some of them will either say, yeah, I think I want to try this. And I say, no, there is no try. There's only do. For Star Wars fans, they will actually appreciate that.
I like the quote, even though I can't say I know enough about Star Wars to be a fan. So there we go.
But this is not a gimmick. This is not something that you just try. This is simply a way that you do your cash management system. You just change the place that you store your money. Mm-hmm. You were storing it in a bank. Now you're going to store a majority of it, not all of it, because you need 15-minute money, I call it. But you're going to store a majority of your money, and you're going to make major purchases and fund major things out of this particular pool of money. So when you boil it down to the simplest part of it, it's really the cash management system, just a different place to store your money.
Bruce, we are going to be continuing on this series. We also have guests coming up on the docket, and we also have other conversations that we have also. So I can't say this is going to be next week, but the next part of the book, we're going to be digging into part 2 of Nelson Nash's book, Becoming Your Own Banker. And sorry, I keep holding it on the wrong side for my camera there. But this digs into the human problems, understanding Parkinson's law and Willie Sutton's law, and what is the golden rule. These are really a key part of rethinking your thinking. And he also talks about the arrival syndrome. And what's so interesting, Bruce, you mentioned earlier that we need to rethink our thinking and not just think about what we're thinking, but why are we thinking that way? I think it's so challenging because we normally just hear things and then we're exposed to information. We might regurgitate the information we were exposed to. We don't actually consider the source of the information, how true it is, how logical it is. I mean, we're not fully logical, rational beings. I would love to say that we are, but we're not. And I mean, this makes me think about, how do we know that we believe the right things about the world? How do we know we believe the right things about other people, about ourselves, about how we should interact with others? And I mean, I can't say this is the foolproof way of knowing, but usually it has to do with going back to the old way that has been time tested. I'm not saying that we should never embrace new things and new technologies, because obviously God's given us a mind to think and to create and to do new things that have never been done before. And that's the advances of science and technology and medicine. They're all amazing for humanity. And we're supposed to continue growing along those lines. But at the same time, there's principles. I guess maybe I should say principles. It's not just the way of thinking, it's the principle behind the thinking. If it's age-old, time-tested, proven way of understanding the world, that is going to be more solid beneath our feet than something that's brand new, that's untested. And that's a really good component, not the only piece, but a good component of evaluating our thinking. And that's one of the reasons why I love infinite banking. I mean, it's something that's been around for a long time and probably used more historically than it's being used today, which points to the time-tested nature of this being around for a long time. All right. I know that I missed some comments. Bruce, was there anything we needed to attend to? My system's glitching. It tells me there's no live viewers right now, but I know there are. And I know that I responded to a couple and it kicked them out. So I'm sorry.
Yeah, I have several, but basically we covered all of them in one way or another. So I think we're good with the comments today. And thanks everybody for chiming in. It really is helpful with our content to actually target what you really want to know about. So thanks a lot for commenting.
Absolutely. Thanks for being with us on this conversation today. If you are ready for next steps and you want help to address this issue in your life of infinite banking, a place to store cash, thinking about leaving a legacy, we would love to have a conversation with you. And you can do that very simply by going over to themoneyadvantage.com. And there's a button on the front of our page where you can book a conversation on our calendar. I was gonna say book a calendar, that doesn't work. Book a call on our calendar and have a conversation about what you're looking for, what you want to do, and how we can help you get there better and faster. So with that being said, please remember success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.